Joining me again is Jeff Christian. We're now in Orlando, Florida, so we're taking Commodities Confidential back on the road. Jeff, thanks so much for being with us.
It's good to be here.
So, Jeff, I'm happy we found a place with a bit of breeze here in Orlando. I know you're a speaker at the IPMI, and I want to talk to you about the PGMs, but before that, you shared with me the other day something really interesting that I'd like to share with our viewers. You sent me a chart which showed the movement of gold in Switzerland, which I find interesting. In the gold space, we've been speaking about how gold has been moving towards China with outflows out of New York, out of London, out of Switzerland towards China. But you're saying in this chart that you sent me, not quite so.
Well, there is a tremendous amount of gold moving out of traditional markets, Switzerland, UK, New York, to China. But there's even more gold that's going into Switzerland and staying there. So we showed, Chinese investment demand was about 43 million ounces cumulatively from 2008 to 2013. But if you look at the net import, and people have been looking at net exports from Switzerland and say, oh my God, last year there was 89 million ounces of net of gross exports from Switzerland. And we said, yes, that's true, but there were 99 million ounces of gross imports. And there was about 9.8 million ounces of gold that came into Switzerland and stayed there. And if you look at it from 2008 through 2013, it comes down to about 147 million ounces of net imports. About 4 million ounces was used in jewelry and watches. So you have about 144 million ounces of gold that came into Switzerland and stayed there. So actually investment demand in Switzerland is much higher than it is in China. And much more importantly, Switzerland's not running out of gold. And in fact, it has, since 2008, added about 10% of global private investor holdings of gold in Switzerland alone.
So what does that say to you, Jeff? When you see that number, what's it saying? There's an appetite for gold that remains in Europe, that remains in North America. What's it saying to you?
Well, I think there are two things. And the one thing which I think is extremely important is it drives home the extent to which the gold market really doesn't know what's going on in its own market. I mean, all these people have been talking about all the gold leaving Switzerland. They're completely off base. I mean, this is incredibly stupid. Second thing, and much more important and much more bullish, I think, is the fact that, yes, this is not a China story. You don't need Chinese demand to see higher gold prices. You are, in fact, seeing a tremendous amount of gold being purchased by investors from around the world, a lot of which is being stored in Switzerland as well as other countries. We talk about net investment demand last year of about 32 million ounces, down from 41 million ounces in 2011. But gross sales by investors were probably about 50 million ounces or more, which means that gross purchases by investors were probably someplace north of 80 million ounces. That is an incredibly large amount of gold being bought on a gross basis by investors. 50 million ounces of it last year was met by sales from other investors, so you only had 32 million ounces of net. But the fact of the matter is that investors worldwide remain tremendously interested in gold.
Jeff, how were you able to track this information?
Well, we use a combination of trade data, good analysis of the trade data, and also our contacts around the world in terms of the markets. The fact of the matter is the people who have been talking about all the net exports into gold, of gold out of the UK and Switzerland, haven't been looking at the import side of the balance sheet.
When you say all these people, are you referring to media? Are you referring to a group of individuals? And I don't need you to say exact names, but who are these people?
It's really newsletter writers. And people, some of them are people who sell gold to investors and they're looking for reasons to keep investors bullish. Some of it are newsletter writers who have, they have beliefs. And they're looking for information to confirm the beliefs. They look at the exports, they see the exports, they say, that's all I need. They don't bother to look at the imports.
All right, Jeff, before I let you go, let's talk to PGMs, mostly because CPM will be launching their PGM Yearbook. I'll be moderating the discussion taking place in New York on June 24th. I invite those interested in the Platinum Group metals to attend this session, which will have a panel featuring really high-level individuals. Jeff, what can we expect to hear there?
Well, CPM Group will reveal its PGM Yearbook conclusions, and the conclusions are pretty positive for gold, or for platinum and for palladium. We have tight markets. The platinum market, people don't realize the South African platinum producers are already producing 20% less platinum year in, year out than they were 6 years ago. And it's a market that is facing tight supplies, We have a strike right now. At some point, the strike will settle. And when that happens, the price might spike down. But then there are a lot of investors that are waiting for that spike down to reposition at lower prices.
Well, Jeff, I think that was a point Jonathan Butler from Mitsubishi Corporation raised before us. Why wasn't the price of platinum and palladium really moving now in the midst of the strike? Should it not have been going higher?
I don't know what Jonathan said in answer to that question, but we look at it, and what we've seen is a lot of stale bull liquidation. Investors who bought platinum, between $500 and $800 in the 2002 to 2005, 6, 7, and they then went through this extremely volatile period, 2008, 2011, and they've been selling platinum, and they've been selling it since late 2011 through 2012, 2013, and into the first quarter. And so you've got the stale bull liquidation, and you've got sales by the platinum industry, the producers in South Africa, from inventories that they built up before they made the strike occur. And so you've got a well-supplied market. And then you have other investors who say, okay, you've got a strike in South Africa, you've got bigger structural problems facing the South African industry beyond the strike, you have increased tension between Russia and the West over U.S.-Ukrainian policies and stuff like that, and you have rising fabrication demand, especially in the European diesel market, which is recovering for platinum, right, and the price is flatlining. So if the price is flatlining in this kind of bullish environment, what happens when the strike settles? So in addition to the stale bull liquidation of long-held positions, you also have other investors selling into the market, which is keeping the price down.
Jeff, on that note, I look forward to the discussion. Thank you so much for being with us.
I want to thank you for the interview, and I also want to thank you for agreeing to moderate the discussion. I think it's going to be really great because we have, in addition to CPM Group, we have several people from the industry, really knowledgeable people, and it should be a fabulous open discussion.
And we have the link below for those interested in registering. So Jeffrey, thank you so much, and thank you for watching our coverage here from the IPMI. We'll have more for you. We have George Giro coming up next, so stay tuned.